The Reserve Bank has kept interest rates on hold. Let's have a look. Hello everyone, Florian here and welcome to another episode of HeiseSays. Grab your stein of coffee and let's have a look at the RBA's latest statement from Philip Lowe about the cash rate. They've kept it on hold. Now before we look at our governor's statement, we'll bring up, here we go, trading economics. Now, the consensus and the forecast was that rates would increase to 4.35%. We can see it here and here, but it's at 4.1. So they've been off for the last 2 months. But what about the financial gigachads, the viewers of the channel? What did you say on the poll I asked yesterday? The real important people, 71% said the RBA will raise rates tomorrow. And no, they didn't. 29% said no. You were right. There you go. Let's look at some of the comments here. We'll go newest comments first. I said yes, last poll, so I'm sticking with it. I honestly think there's a good chance they won't, though. The data has moved a lot, and it's less likely now. It really should be an option for them to wait 2 weeks to see what happens. 14% in 2024, always sexy is saying. I doubt that. You need, I hope so, to correct years of stupid low interest rates they've incurred indirectly. Yeah, it's not going to happen. Philip will smash another one out to make sure before the handover, but experts are saying we've already gone too far, but not if the RBA is hell-bent on 4.5% unemployment. My understanding, which could be wrong, is because the US have raised theirs, Australia has to raise ours as well. Or there could be too much demand for the AUD, and they could cause runaway inflation. I hope I'm wrong. She can't otherwise. Why did they get rid of what rat face? No, he's still there. Lowe hasn't left yet. I hope so. There's a 100% chance of whatever they do. Odds are for suckers. So yeah. A PhD in economics is about as scientific as a degree in witchcraft. Who the heck knows? Maybe a 0.15 rise. No, they will hold. Financial gigachat here. I voted no because of intuition, which is far more powerful than data. And I'll give that a heart. So let's have a look at what our governor has to say in his statement. At its meeting today, the board decided to leave the cash rate target unchanged at 4.1% and the interest rate paid on exchange settlement balances unchanged at 4%. Interest rates have been increased by 4 percentage points since May last year. The higher interest rates are working to establish a more sustainable balance between supply and demand in the economy and will continue to do so. In light of this and the uncertainty surrounding the economic outlook, the board again decided to hold interest rates steady this month. This will provide further time to assess the impact of the increase in interest rates to date and the economic outlook. Inflation in Australia is declining, but is still too high at 6%. Goods price inflation has eased, but the price of many services are rising briskly. Rent inflation is also elevated. The central forecast is for CPI inflation to continue to decline to be around 3.25% by the end of 2024 and to be back within the 2 to 3% target range in late 2025. The Australian economy is experiencing a period of below-trend growth. Well, technically, if you look at it, a per capita GDP growth has been below trend since 2008, but don't worry about that. That's not important. That's not important. No, don't pay attention. It's just, look at the overall number go up. Anyway, and this is expected to continue for a while. Household consumption growth is weak, as is dwelling investment. The central forecast is for GDP growth of around 1.75% over 2024 and a little above 2% over the following year. Conditions in the labour market remain very tight, although they have eased a little. Job vacancies and advertisements are still at very high levels, although firms report that labour shortages have lessened. With the economy and employment forecast to grow below trend, the unemployment rate is expected to rise gradually from its current rate of 3.5% to around 4.5% late next year. Wages growth has picked up in response to the tight labour market and high inflation. At the aggregate level, wages growth is still consistent with the inflation target provided that productivity growth picks up. Returning inflation to target within a reasonable time frame remains the board's priority. High inflation makes life difficult for everyone and damages the functioning of the economy. It erodes the value of savings, hurts household budgets, makes it harder for businesses to plan and invest, and worsens income inequality. And if high inflation were to become entrenched in people's expectations, it will be very costly to reduce later, involving even higher interest rates and a larger rise in unemployment. To date, medium-term inflation expectations have been consistent with the inflation target, and it is important that this remains the case. The recent data are consistent with inflation returning to the 2 to 3% target range over the forecast horizon, with output and employment continuing to grow. There are tough, significant uncertainties. Service price inflation has been surprisingly persistent overseas, and the same could occur in Australia. There are also uncertainties regarding the lags in the operation of monetary policy and how firms' pricing decisions and wages will respond to the slowing in the economy at a time when the labour market remains tight. The outlook for household consumption is also an ongoing source of uncertainty. Many households are experiencing a painful squeeze on their finances, while some are benefiting from rising house prices, substantial saving buffers, and higher interest income. In aggregate, consumption growth has slowed substantially due to the combination of cost of living pressures and higher interest rates. Some further tightening of monetary policy may be required to ensure that inflation returns to target in a reasonable time frame, but that will depend upon the data and the evolving assessment of risks. In making its decision, the board will continue to pay close attention to developments in the global economy, trends in household spending, and the outlook for inflation and the labour market. The board remains resolute in its determination to return inflation to target and will do what is necessary to achieve that. They'll do what's necessary to achieve that. So there we go. Let's have a look at the ASX rate tracker. There we go. No, I don't want the dividend tracker. Rate tracker. There we go. I'll bring this one up here. And we'll see where it's sitting now. Yep, I'll accept all the cookies, no problem. Was this a new one? Look at this. They've made it all modern and looking swish. Wow, maybe the RBA ASX is spending time on things like this rather than some bullshit crypto garbage to replace chess, hey? That would have been smarter. Might have paid some better dividends and not let their shares tanked. Anyway, so a rate increase on the 31st. It was only 14% there that the prediction was. So there you go. No change at 86%. Looks like it was right. Anyway, guys, let me know your thoughts and opinions on this one. It looks like, well, once again, the financial gigachads who voted yes were incorrect. Those of you that voted no were correct. No rate rise. Do you think Lowe has one more in him before he leaves? Or, well, has the market already been affected enough that it's going to ease back to normal? Maybe we'll be sitting on 4.1% for a couple of years. You tell me. As always, thanks for watching, guys. There we go. Check out HeiseBim or HeiseDoes if you're interested in other videos that I create. If you want to support the channel, you can on YouTube or Patreon. Use our referral links, buy our pocket squares or other merch, or call me if you need an architect. Take care. Have a great day. I'll see you all next time. Bye for now.